Hi, in this video we're going to talk about restricted stock units. You might have heard this term a lot, and I'm going to explain why it's called restricted stock unit. The restricted stock unit first is a way of equity compensation. Again, as we have covered in our previous video series, there could be different forms of equity compensation, and restricted stock unit is one of them. What it means is that it's restricted in the sense that there is some restrictions when the company grants you these stocks. So it could be restricted by a vesting period, or it could be restricted by a certain performance, and that's why it's called restricted. And the reason it's called stock units is because it's not actually share of your company until it comes into your account. So that's why they name it stock units. So again, restricted stock units is a way of equity compensation that we see. That is the most commonly used form of equity compensation. And today we're going to talk about like how it works, how the taxation works, and some of the other details. So let's see, what are the key terms with restricted stock units? So first of all is your grant details. So typically what happens is when you join the company is going to give you your base compensation, and then apart from the base compensation, you're going to get a grant of restricted stock units. What that means is, and the grant details is what includes all those details of your restricted stock units. It would include how much, what is the amount, what is the total amount of grant you're going to get, and when are you going to get it. And the other thing that's included in the grant detail is the vesting schedule. Typically, what we have seen companies do is a graded vesting schedule. What that means is that at your first anniversary, 25% of your total grant is going to be vested. Vesting usually just means that it's now yours to use, or it is going to be in your account. Then, the next 25% could be at year 2, the next 25% year 3, and then the final 25% at year 4. Some companies, the grading works differently. They have the 25% at the first year anniversary, and then you could have the rest of the grant is equally divided to vest every quarter. So every company is different, but you'll find all the details of that in the grant detail documents when you join the company. We don't see this cliff vesting very often, but there is some cliff vesting where typically with your performance grant that would happen is that, okay, if you're going to get a bonus grant, then it could just vest at the first year anniversary, all of it. So that could be cliff vesting. So let's look at an example of how things work with RSUs. So for example, you join the company and you got a 100,000 grant of shares of the company. So most of the time the company is going to tell you the dollar amount. They're not going to tell you the number of shares. The number of shares is then calculated based on the share price on the grant day. This is what most companies do, but some companies could be different. They could take the average in the past month or something like that. But let's say that the company calculates the share price it looks at the share price on the grant day. So if you got 100,000 grant, the share price on the grant date is $100. So the number of shares that you're going to get is 1,000. Very simple, 100,000 divided by 100, you're going to get 1,000 shares. On joining date, that's it. All you have to do on joining date is accept your grant. You're not going to get any shares or anything. Now, if we are talking about the graded vesting schedule over 4 years, so what happens at your first year anniversary, 1/4 of this 1,000 shares is going to vest. So at your first year anniversary, you get 250 and so on. So by the time you have at your 4th year anniversary is when you're going to get your 1,000 shares. So you have to stay with the company for 4 years to get this whole grant. And those details are always in the grant documents. Now let's see, a big question that we get on RSU is that how will I be taxed? So let's see how the taxation works for RSUs. At vesting, and we are going to just continue our previous example. At vesting, you get 250 shares, that is vesting. However, on vesting date, this is all ordinary income tax, and it is going to be treated like W-2 income. So similar to your salary, there are going to be taxes withheld from your vesting. And so usually what we have seen is that the companies would withhold 22% for federal taxes. And in this example, we're assuming there's no state tax because we are here in Texas with no state tax. So if you're in California or some other state where there is state taxes, they might withhold more on this. But typically what we have seen is that the companies would withhold 22% of your 250 shares or sell 22% of your 250 shares, which is 55 shares. And typically you would see 195 shares coming into your account. So, and the amount would be the share price on the vesting date. So the share price at your grant date does not play a part anywhere else except to calculate the number of shares you're going to get into your account. Once you know the number of shares you're going to get into your account, that's when on the vesting date you will get the 195 shares multiplied by the price of the share, multiplied by the price of the share on that date. So you'll get 195 shares in your account. However, remember, you might, even though the company just withheld 22%, you might not be in 22% ordinary income tax bracket. You might fall in the 35% income tax bracket. So you will owe taxes, 13% more taxes at the time you file your taxes. So that's something that you have to think about it, is that even though you're getting this, there's only, you might owe more taxes on your vest. So typically what we say is that you take this amount, 13% of 250 shares, which is equal to 33 shares, sell that on the vesting date, and keep that amount separate in a savings account or something, so you have this money available for taxes when the taxes come due. Now, assuming that you have done all of this, you would be finally left with 162 shares in your account. So now let's look at the taxation at sale. So once you have this 162 shares in your account, you are free to do anything with it. You can keep it, and we're going to talk on the next slide about what you should do with it. But let's say you decide to keep it, the 162 shares. And after 6 months, you sell these 162 shares. What happens is that if you sold within the 1 year of vesting, not grant, if you sold within 1 year of vesting, all this, you're going to have to pay short-term capital gain, assuming that the share price increased. So the way it's going to be, your cost basis is going to be the share price on vesting date. So that is your cost basis. And if the share price increased after the vesting date, then you're going to pay short-term capital gain if you sold within the year. If you sold after 1 year of vesting and the share price, again assuming, goes up, you're going to have to pay long-term capital gain, which is what we want because that's the favorable rate, and that's lower than the short-term capital gain. So again, think about it that your cost basis, and that's where most people get confused, is what is my cost basis? So your cost basis is the share price on the vesting date. Now let's talk about your decision framework. Like most of the time we get clients that come up and say, should I keep my company stock? Or they feel that they're obligated to keep the company stock and they cannot sell it. So let's look at, should you sell or not sell? Now think about it is that you're working for the company, your paycheck comes from the same company, and you are also given the stock of the same company. So there is something called concentration risk. You have your financial assets are concentrated into this one company. So the thing that we tell most of our clients, and it's a very easy decision framework, is that think about the RSUs as a cash bonus. Now, If your company was to give you 10,000 of cash bonus, are you going to go back and buy your company stock with that? If your answer is yes, then probably you can keep the stock. If your answer is no, then I think you should sell the stock and use that cash for other purposes. Also, something that could make your decision making easy would be just just decide on what percentage of your portfolio do you want to be allocated to that stock. And again, there is no set number. Based on your risk tolerance, based on your personal situation, you could be comfortable with 5% of your total portfolio in the stock, 10%, or even more. Once your RSU grant is over that percentage, 5, 10, 30, whatever percentage you decide to keep, then just sell the stock. Then it makes the decision making very easy. Now, what to do with the cash? That's another thing. We have seen some people include that cash in your monthly budgeting, and we would always advise against it, because your RSU again is a bonus, and every time you want to go through your monthly budgeting, you want to include only your paycheck in it and not the bonus, because typically that's what we want to save and put for other purposes. So don't include your RSU income in your monthly budgeting, because again, it's not a fixed amount. It will vary depending on the stock price. Once you have sold your RSUs and you have this extra cash, then do not include it in budgeting. You could make decisions like maybe you should lump sum fund your 529 plan for your kids. That's a great use for RSU bonus. If there's a home remodel project that you have been wanting to do, maybe you should do that. And maybe there's a big vacation that you have been wanting to take. So that could be a good use of your RSU cash. However, before you do all of this, you want to make sure that your emergency fund is fully funded. So the way to think about it is, when you get the cash, do not use it for monthly budgeting. Fund your emergency fund. After that, if you have money left, you can do your 529 plan, want to do a home remodel, vacation, or if you have money left, you can just put in your brokerage account in a diversified portfolio and let it grow. So again, this framework is just a very general framework. This video is intended only for educational purposes, and it is not personal financial advice. If you need personal financial advice, please contact your financial advisor.